So let me, Aditya has given a quick background on me. I would probably take 1 or 2 minutes and give you a quick introduction on Moravia Capital Investments so that the audience gets a better idea on the lens or the hat that we wear. So Moravia Capital Investments is a global fund of funds, and our mandate is to build a diversified international private equity portfolio for our investors. So in terms of strategy, we are investing across strategies, venture capital funds, growth stage funds, private equity funds, and so on. And in terms of geographies, we've been investing in the US, Europe, and Asia. So that's the broad mandate. And we've been evaluating funds for a while now, and we've built a healthy portfolio, about 15 funds. And probably I'll put some of those experiences here for the benefit of the audience. So let me begin. Did you know that there are more than 20,000 funds in the international market? And I mean, out of that, maybe more than 500 funds, active private equity funds in India. So that's a large universe, and it's not an easy task to identify and conduct due diligence on the best managers. I mean, all the investors who are putting in money in private equity are there for the long term. And you don't want to get stuck with a manager who's not doing the right strategy or not performing or whose numbers are not correct for a long period in time. So I think due diligence is of utmost importance in private equity. And one other peculiar feature about this asset class is that manager selection is really important as compared to the other asset classes. I mean, if you look at this chart, essentially the light blue bars is the dispersion of returns between fund managers of listed equities. So essentially what it says is that broadly, if you were a worse performing listed equities fund, and if you compare the performance with the top 5% best performing listed equities fund, the dispersion would be so much. And the dark blue bar is the dispersion between the returns generated by private equity fund managers. This chart essentially is for leverage buyouts, but that brings out the message that if you end up selecting a wrong fund, the dispersion could be as high as 55%. So, I mean, due diligence and fund evaluation are really the key things for getting the returns or meeting your objectives of returns from private equity funds. Now let's get into what makes it so challenging. I mean, what's so difficult? What makes it so challenging to conduct due diligence on private equity funds? Essentially three things. I mean, there are a couple of points, but these are the three key points that I would like to highlight. One is the lack of data and transparency. I mean, the data is of course available once you ask for it or request for it from the fund managers, but it's not easily available, and the transparency and the depth of the data is not as high as when you would be evaluating, say, listed equities fund managers, or if you would be evaluating investing directly in a listed entity. So that makes this investment challenging. The other point is limited benchmarking possibilities. I mean, taking a comparison with listed equities, if you were to ask Rohit Sharma, he will tell you mutualfundsahiye.com pe jao. I mean, and you will have all the information of all the fund managers, their performance, their portfolio, or you can go to Morningstar or Money Control or any such website, and you will have a host of benchmarking possibilities. You will have a lot of data which you can collect, you can compare, and so on. But that's not the case with private equity. I mean, how do you judge the performance of a private equity manager as compared to other private equity fund managers? How do you know that he is outperforming the manager under consideration, is beating the market, or he is outperforming? That's a challenge. There's no real benchmark or an easy benchmark that's available. Last year, SEBI's come up with a couple of benchmarking rules, but that is still very nascent. I mean, it gives limited data as of now, but I'm sure this is going to grow going forward, and this is a welcome step and a good beginning from the regulator and the industry body who's managing it for the time being. I think that's a great step, and hopefully going forward we would have more data, more comparable numbers to help with analysis. And the third point is long time lag between commitment decisions and performance outcomes. I mean, typically the investment period of funds is anywhere between 3 to 5 years. So from the time you make the decision to invest in a private equity or an alternative investment fund, the fund manager would take 3 to 5 years, and you give maybe 1 or 2 more years for the real performance to show. And that's a long time period to figure out whether the decision that you've made to invest in the fund is going right or is not correct. So that time lag kind of makes the process of applying the learnings to your other investments kind of difficult and very slow. So that makes it challenging when you're conducting the due diligence and applying those learnings going forward. One other stark difference when conducting due diligence, what private equity fund managers do when they invest directly into companies, and what LPs do when they commit or when they invest into private equity funds, is that when you are doing a due diligence on a direct deal, there are so many avenues that you can check, and you are essentially getting into that same company or that asset which you're going to own when you're making an investment. So your due diligence would reveal whether the revenue numbers or the EBITDA numbers are correct, whether the assets and the liabilities are recorded correctly. Would the EBITDA be different? Are there any adjustments that need to be made? If it's a financial services company, are the bad debts recorded properly? NPA numbers are correct or not, and so on and so forth. And based on that, what you can do is you can defer your valuation number. You can tweak your valuation, and you can say, okay, if the EBITDA is not going to be 10 million and it looks more like 8 million post DD, the valuation is going to be X times the EBITDA. So you can adjust your valuation accordingly and still take a decision. But in case of investment in a private equity fund, the decision is binary. Either you invest or you don't invest. You cannot say, I will invest, but at so-and-so valuation. So that's a stark difference. So DD is kind of really different as compared to doing a direct deal. And also the parameters we look are different. I mean, when you are investing in a new fund or the next fund of a private equity manager, you can only do DD on the previous funds that were there. But essentially, you're not going to be investing in those funds. That only can give you a sense on how the manager is behaving, how the systems are, how the accounting is, and so on. And you would be investing into a blind pool of fund which would invest in or which would acquire assets in the next 3 to 5 years. So it's kind of challenging as compared to the usual DD that we do for direct investments. Maybe now let's get into some of the key aspects which from our experience are the most important when evaluating a private equity or an alternative investment fund, and also part of DD. I mean, some of these items are part of due diligence, some of these items are part of evaluation. We do bits in evaluation, and then based on our decision, when we conduct a detailed due diligence, we check those aspects once again, and so on and so forth. So I'm combining both these aspects here and not splitting them on what are the evaluation items and what are the DD items. Essence is to give you a sense on the parameters that we consider, or which a typical LP would be considering when they are conducting due diligence on underlying funds. First, to start with, is the strategy. I mean, these are the four parameters which you see here: strategy, track record, team, and execution, and other fund terms. These are the four broad heads that we believe are most important. Let's get into the strategy aspect. When we look at strategy, the key thing that we look for upfront is whether this strategy will fit within our portfolio construction or not. I mean, the strategy might be doing very well, might be generating returns, and so on and so forth, but does it make sense within our overall portfolio or not? That's the first checkpoint for us. And if that ticks in, then probably we go ahead and we believe, yeah, okay, this is something for us, something for our portfolio, and something for our investors. Next point we look at is whether the particular strategy under discussion would make returns in the current environment. I mean, the fund manager would show his or her past track record, how well the strategy is done. But the point of discussion within the team is that whether this strategy makes sense now at this point in time. I mean, maybe a strategy which has worked 5 years back may not be the best strategy today. Maybe the space is more crowded now. I mean, there are more PE funds who've come in making deals in the same space, driving up valuations, or there aren't sufficient deals in that space now. Could be anything. So essentially what we need to evaluate is whether the strategy would make returns and does it make sense in the current environment. I mean, take example of, say, VC funds investing in consumer deals or enterprise SaaS. Probably that was a space 5 years back, and now it's maybe overcrowded and valuations going over the roof. We don't know. I mean, we'll have to see. So points like those, I mean, that help in terms of making up our assessment on whether the strategy makes sense at this point in time or not. The next point then we look at is how different is this strategy from the rest of the players in the market. And I tell this to a lot of people. I mean, if the strategy for everyone is the same, if everyone is doing the same thing, then the returns are going to be the same. If you do something different than what the rest of the competitors are doing, then probably there's a chance of making better returns as compared to the rest. That's what we believe. So we need to look for a differentiating factor, what helps in generating better returns as compared to the competition or other funds in the market in the same space. And this could be anything. Does the fund have better sourcing capabilities? Do they have better value addition capabilities? Do they have in-house teams which can help the company grow revenues and profits faster? Or do they have the ability to buy deals at favorable valuations? Anything. I mean, those are some of the thoughts or some of the examples that I have, but that's essentially what determines whether there's a differentiating factor or an edge as compared to the rest or not. I mean, let me take one example here of what we saw in 2019. This is when we were conducting due diligence on a couple of buyout funds. We were looking to invest in the US. I mean, that's also a market I've been looking closely. And typically in the US, what happens is the leverage buyouts, the funds like to acquire companies which either come with a running management, that is the existing management, or the promoter is going to continue for a small share in equity. Maybe they leave 20 to 30% for the promoter, and the promoter or the existing management continues to run the business. I mean, the leverage buyout shops in the US have a lot of value add or capabilities which they help the company grow, but they don't want to get inside the company and the run company on their own. And that's the majority of the buyout shops that we've seen. And we came across one fund which was doing really the opposite of this. They said that we don't want to buy companies which come with a running management. We want to buy companies which don't have, or the CEO or the promoter does not want to run it. So they were looking at companies like that. And what they did was they've built a team of CEOs, the best-in-class CEOs running mid-sized companies, and they've already hired them and kept them on the bench. So what they're saying is, we have the CEO who will run the company, and now we will find a company which he can run, which fits his abilities. These are best-in-class CEOs. So we will find companies which make sense from an investment point of view. And we have a CEO who is going to go inside the company day one and knows exactly what he needs to do. And we really like that strategy. Of course, there were other elements of the strategy which also we liked, and we invested in that fund, and that fund is doing really well. So examples like these, what make funds different from the rest and help them in doing better deals and generating better returns for the investors. On the strategy, other thing which we look for, is there any deviation from the previous fund strategy? I mean, the track record on which we rely, which belongs to the previous funds. And if there's a change in the strategy for the new fund, that really does not gel well with the investors. So we really look for aspects like these, whether there's a shift in strategy. I mean, if, for an example, if the fund was doing maybe seed stage or pre-series A kind of deals, and in the new fund, they're looking to do series B deals, then yeah, probably that's not something what we would look for. Similarly, a related point is an increase in fund size. A lot of times, managers increase their fund size out of proportion. And then what is important while doing the due diligence is to see whether they are moving out of the space of the strategy that they were doing in the previous fund, or they are sticking to that and going to do more deals. And if they are sticking to that strategy and going to do more deals, what is important to see is that do they have the bandwidth and have they increased the team size in order to take care of the additional deals that they need to do. Yeah, so these are some of the aspects we look in the strategy. The other thing that we also look at, which is gaining much importance in these times, is the ESG aspect. I mean, we always were looking at well-governed funds, so the governance aspect was always important. But yeah, I mean, environmental and social concerns are also very important now, and we would look for strategies or funds which adhere to the ESG standards in some sense or the other. So that's also an important aspect going forward. Let's move on to the next parameter, which is the track record or the past performance. And as I said, I mean, essentially the LPs are investing in a blind pool of funds, and what they rely on the most is the past performance of the fund manager. And in this, the key aspects we look at is the absolute performance, relative performance, and also the consistency of performance. Absolute performance means we're going to be looking at the IRR numbers, the TVPI numbers, and so on. And from a due diligence point of view, we really double check or do the calculations for IRRs and the TVPI for ourselves. I mean, of course, the fund managers are doing it and sending it out. But yeah, we would like, as our due diligence exercise, to check these numbers once again, check the Forex rates, those are used, read the footnotes very carefully, because yeah, I mean, those are interesting footnotes. You would find out what's gone into the calculations and what's not gone into the calculations from those footnotes. So that's something which investors need to keep in mind when they are due diligencing on the numbers. And of course, I mean, net numbers are more important than gross numbers. We would like to see what are the returns the investor would make post carry, post expenses and fees, and so on and so forth. The next aspect is the relative performance. I mean, this is easy. You can be looking at absolute numbers, and yeah, I mean, those might be looking good, but it really doesn't make sense till you compare it with what's happening in the rest of the market. I mean, maybe similar vintage, similar strategy, other funds are doing maybe much better. That gives an indication about the quality of the fund manager. So doing a relative benchmarking and comparison with other funds is also important. And also comparing with the listed equities index. I mean, we have something called as a PME comparison, which is also important, which essentially says that if you had invested similar money at similar time frames in listed equities of a benchmark, what would you have made? So that's a comparison with listed equities, which kind of makes sense. And the next thing which is interesting, which we look at, or any investor should look at when evaluating the track record, is the consistency of performance. So consistency of performance across previous funds and also across deals. A lot of times what happens is the performance of the previous fund is looking really good, but that's more so because of maybe one hit deal that he's had where it's an 8x or a 10x, and maybe the other deals were just about okay, but the overall fund performance looks good. So what one could do when performing due diligence is that leave out the top performing deal and the worst performing deal, and then just evaluate the ones in between. That would give a sense on whether this is more of a one-off performance or this is more a consistent performance. And with, I mean, if there's sufficient data available, what we also do is do a lot of slicing and dicing of the past track record and numbers in terms of how have been the returns by segment, how have been the returns by stage of deals, venture capital, growth stage, or late stage, and so on. We also do slicing by sector, whether it's a healthcare deal, those are performing better, or technology deals are performing better, and so on and so forth. So that's really the interesting part when comparing the numbers and figuring out which are the consistent performers, which are the relatively better performers, and then make up the decision. The other important aspect on the track record, not so much in the Indian context as of now, but I'm sure this will gather steam in the years to come, is the use of credit lines. What we are seeing a lot in the US and so on and so forth, also in Europe, is that more and more managers are using credit lines to bridge the gap in terms of capital call money being coming in from the investors and the deal transactions being done. But I mean, over the past years, it's more become a game to boost the IRRs. What essentially the fund managers in the US and Europe can do is borrow money from the banks at a lower rate because the interest rates are so low there, and defer making capital calls to their investors. And then, I mean, these are short-term borrowing lines, a year to year and a half. But yeah, I mean, they utilize it to the fullest and then repay it using the capital calls from the investors. What that does is it kind of helps them boost the IRRs by a couple of percentage points. So we try to analyze the impact of credit lines on these funds and try to compare apples to apples, and then, yeah, I mean, make a decision while evaluating these funds. And the last aspect on the track record is to look at the valuation methodology used by the fund managers. A lot of times what we see is that when the manager is about to get into raising the next fund, they would maybe boost the valuation of the unrealized portfolio of the previous fund. So optically, the numbers look much better. I mean, we try to dig into all the previous quarterly reports and see that the valuation methodology has been applied consistently across quarters for all the assets. And that gives a sense on whether the valuations put in the marketing material are reasonable, or are they conservative, or are they very aggressive. I mean, we need to have the skill to be able to see through the marketing that comes in a marketing material. Yeah, I think these are the key points. I mean, just to stress once again, I mean, past track record is really important because that's the crucial aspect which defines how the fund manager hopefully would do in the future. Moving on to the next point, or the next aspect for due diligence, is the team. Again, I mean, probably I'm repeating myself, but yeah, essentially we are investing in a blind pool of capital or a blind vehicle. We don't know what's going to come in. So what we are relying is on the managers to make the best investment decisions. So evaluation of the team is definitely an important aspect while conducting due diligence. And here, I mean, there's not much quantitative data that would be available. You really have to rely on qualitative and softer aspects when you are judging some of these parameters about the team. And yeah, I mean, in times like these where physical meetings are not possible, it's difficult to figure out some of these aspects. But yeah, this is definitely one aspect where physical meetings would have helped much better. Let's get into the key points, maybe run through them. Quality and experience of the team, that's the three criteria. How deep is the experience of the team members? What is the quality? Have they made investments in the past? How many deals have they done in terms of investments, their previous roles, previous jobs, and so on? And one key aspect that we look for is whether the team of managers have seen business cycles in the past. Have they seen one or two crashes in the past? Because when we are investing in a private equity fund, the fund life is 8 to 10 years. And every couple of years, we see a major correction in the market, may it be due to COVID or great financial crisis or dot-com bubble and so on. So essentially, in that 8 to 10 years of the life of the fund, definitely there's going to be one big correction or a big crash or a crisis, so to say. And if the manager is fairly new and have not seen a crisis or experienced that before, then it's going to be difficult to navigate from a crisis like this when it comes in the new fund. So this is something important that we look at. And of course, the size of the team is also very important. How many professionals do they have? Do they have the bandwidth to do the number of deals that they promise from the new fund, and so on? The next aspect is the cohesiveness and stability of the team. Here we need to figure out whether the team is really gelling along well and whether the team will remain stable for the next couple of years in the new fund. Just taking an example, I mean, we were evaluating one fund in Asia, and very good team, very strong past track record. And there were three partners in this fund. And one of them, I mean, they had mentioned in the marketing material and also in the meetings that one of them is not going to be full time with the fund. He's going to be dedicating majority of the time to the fund and maybe not being involved 100% of his time for the fund. And that person had a really good track record in the past, and we were not sure how long or what is going to be the quantum. I mean, of course, the fund manager is saying he's going to be involved for a majority of the time, but we wanted to dig in deeper into this. And when we had one of the meetings in their office, that's when we picked up a softer cue that there were only two cabins in that office for the partners and not three for three partners. I mean, of course, real estate in these large cities in Asia or elsewhere is expensive. But yeah, I mean, we would have expected three cabins to show that the third partner is also going to be substantially involved in the next fund. So things like these, I mean, you have to pick up cues like these to figure out whether what they are saying about the team is true or not, and whether the team is gelling along well or not. I mean, just taking another example where, again, the team was very cohesive on the paper. They had worked for a couple of years in the past, but when we went for a meeting with them, we could see visible differences in opinion within the team, which is something what we don't like. I mean, the team should be there with the investors for the next 8 to 10 years. This is a long-term game, and we're not really looking at teams which would just invest and maybe not be there. I mean, the key people whom we are trusting should be there for the rest of the fund life. That's the key aspect. And related to that is the key man risk, whether the key person of the fund will remain with the fund for the rest of the tenure of the fund or not. That's something we need to judge. And also whether for whatever unforeseen circumstance something goes wrong with the health or an accident, if that person is not there, what happens to the fund? Is the next in line team capable to deliver on the strategy and make those investments and generate those exits? That's something what an investor needs to look at. I mean, just taking one example from the US, where we had a very strong leader who had generated fantastic returns over the past 20 years, made 4 or 5 fund generation, successful investments. And probably we thought that there is a very strong key man risk in that, because he was an extremely aggressive leader, leading the team from the front, dictating the culture. But what we realized when we had a couple of meetings with him, that he had built a very strong next in line to succeed the fund, just in case something goes wrong with him. And we could see that the next in line were also talking the same culture and had the same aggression and zeal to make returns for the investors. And we finally committed to that fund. That fund is also doing quite well. And the last aspect on the team is the alignment of interest. We would always love as investors to see that the team is aligned with the success of the fund. And this is usually achieved by a GP commitment. I mean, the managers putting their own money into the fund, the team putting their own money into the fund, the carry split amongst all team members so that they are motivated and remain with the fund. Things like these, which help in determining the alignment of interest. Yeah, so that's on the team aspects. Let's move on to the next or the last most important aspect that the investors should look for is the execution of the strategy and also fund terms. Execution, of course, deal sourcing, very important. I mean, when you meet managers, everyone would say that they have a proprietary deal sourcing. And when we conduct our due diligence, that's one of the key aspects that we need to see whether the deal sourcing has been proprietary or has been same as what the manager is promising or is mentioning in his material. That's an aspect that we need to look for. The other aspect is the value creation. This is really important. I mean, every fund manager has the money which they are investing. So the companies, the investee companies are definitely looking for more than the capital that the fund brings in. And that's really the differentiating factor. I mean, it's really important for buyout deals, but it's equally important for growth stage deals. And every fund manager says that we do value creation for our portfolio companies to an extent. But yeah, I mean, the crux is in seeing what part of that is real in terms of what they are saying. So if an investor looks at the past deals and what concrete examples the fund manager has to share about it, that would give a sense on what's really the extent of value creation by the underlying fund. Next aspect is the investment and the DD process. I mean, just the way the investors have their own investment thesis and the DD process. I mean, we would like to see that the underlying funds also have a very institutionalized and a robust process and an in-depth process for conducting due diligence. I mean, in fact, their DD processes need to be much more robust and deeper than what LPs would be doing on the fund managers, because essentially they are getting into operating companies, live companies, which have operations, which have revenues, assets, and liabilities, and they need to make sense whether the company will continue to grow and will deliver the returns that the investors are looking for. Yeah. And then the last aspect, but very interesting, is the fund terms. I mean, fees, carry, these are the things that we need to look at. Broadly, these are the aspects where we would like the fund managers to be more transparent. Of course, that's the case in India. Things are very simple, very transparent. It's not very difficult. But I would just like to draw one example of a manager we saw in US. I mean, a couple of years back, I mean, when we were not doing fund investments, or when I was not doing fund investment earlier on in my career, I read articles where it said that the US pension funds are worried about the fees they are paying to the underlying fund managers, and they don't know how much fees do they actually pay up to the underlying fund managers. And there was a big hue and cry in the US, in the industry, and so on and so forth. And I was wondering, what's the fuss so about? How can it be so complicated? It's so easy. It's 2% of the capital commitments. That's as easy as that. Why is it so messy? And in 2018, when we were evaluating a couple of highly successful buyout managers in the US, I found myself in the same boat. I mean, I just could not understand what's the amount of fees we will end up paying to that fund in the end. I mean, they sent us an Excel sheet with the fee calculations, with the waterfall in terms of the deals, exits, and so on and so forth. And it was really complicated. I mean, there's management fees, there's transaction fees, there's monitoring fees, there's fees for the operating professionals, there's incentive to operating professionals, there's shared expenses, and so on and so forth. I mean, you just can't figure out what's going to be the final fee amount that gets paid by the investors. And some of this gets set off against the management fee. Some of it does not get set off against the management fee. It literally took me 2 days to decode that Excel sheet. And I must admit, I still don't have a clue whether I understood that completely or not. So yeah, I mean, that's the situation in the US, but yeah, fortunately, that's not the case here in India. It's pretty straightforward in terms of the calculations and the transparency aspect. So yeah, I think that's also something that we need to look at. Yeah, and what happens a lot of times in fees is the transaction expenses are also something an investor should look for. Because in the end, these are paid by the fund investors. So that's something we need to take into account. Again, I mean, just a note of caution here. Higher fees or complicated fee structure or higher transaction expenses does not mean that the fund is not good. It needs to be seen in the context of what's the objective or what's been achieved by these high fees. It could be the case that these high fees are for a reason and they generate a differentiating factor which helps the fund manager in generating much better returns than their competitors. I mean, just so the previous fund which I was mentioning, they had a very strong operating professionals team of about 30 professionals in-house who would then go into these acquired companies and help those companies grow. I also mentioned about the previous fund, I mean, at the very beginning as an example, which was hiring CEOs even before they would acquire the company. And those CEOs were going to be sitting on the fund's payrolls for a while till they found the company. But then the kind of returns they've generated by this strategy are phenomenal. So it really doesn't matter if the fees are high. It's a call by the investor whether they believe paying the higher fees is going to generate an outperformance by the managers, which then really makes sense or makes the fees worthwhile. Yeah, that's broadly on the execution and fund terms. And apart from these, there are a couple of other pure DD items or other due diligence aspects which are also very important, which are basically looking at the past financials. We need to look at what are the past financials. We look at the auditor's reports of the previous funds. We should also look at the quarterly management reports that would give a lot of indication on the quality of the manager, quality of the deals done in the past, quality of reporting, level of reporting, what is the level of data you will get to be able to see where the money has gone and so on and so forth. And the other important aspect is really getting into the details of the deals that have been done from the new fund where the money of the investor will go. That would be a real test of the pudding, so to say, whether it's meeting the strategy that they are promising, whether they have a value addition plan, whether it was a proprietarily sourced deal or not, and things like that. I mean, it's really the live deal that's happened recently, and you can check. And again, I mean, the investors are going to be participating in that deal. So the investors need to see whether they believe this is the right deal and has the potential to generate the returns which the manager is promising. So that's another aspect which investors need to consider while performing their due diligence. And yeah, coming on to probably one of the most important aspects as well is reference checks. Sorry. I mean, it's always great to look at the past track record, the numbers, the strategy, the team doing all the meetings and so on and so forth. But an investor would get real insights by conducting these reference checks within their network. I mean, either investors can check with other investors who've been investors in the previous funds, and that would give a sense on how the investors have been experiencing the fund manager strategy. Reference checks could also be with underlying portfolio funds. There you can get real insights on whether the fund manager has really added the value that he was mentioning in the presentation. Has the company really grown under the investment of the fund manager, and so on and so forth. So these are really important aspects where you get to know things which were not discussed in the presentation or which are not visible in the numbers. So those calls really help in formulating your view on whether the investment makes sense or not. Getting on to the next few aspects, so that's legal and tax due diligence. Of course, this is more for the lawyers and tax advisors to do, but of course, as the investment team, you need to be on top of these aspects as well. On the legal side, it needs to be ticked off that the legal structure is well established in a correct manner. The compliances of the local regulations are being met. The AML, that's anti-money laundering aspects, are also being taken care of. The entities are set up correctly. Things like these are what need to be checked. Of course, the lawyers help in these, but yeah, as I said, the investment team needs to be on top of this. and also the terms of the legal documents. So the limited partnership agreement or whatever is the binding legal document, depending on the structure, there are a couple of aspects that needs to be discussed or needs to be looked at very carefully. Things like co-investment rights, key man clause, MFN clause, side letters, and so on and so forth. I mean, when can the new fund be set up? What's the threshold when they need to, when they are allowed to set up a new fund? What are the drawdown timelines? What happens in case of a default? Also very important. Of course, very unlikely, but that's something that you need to make sure you are aware and are aligned with, because I mean, the contracts need to be completely clear and vetted. Equalization payment, GP removal clause, and so on and so forth. I mean, these are very technical terms being handled by the lawyers. But yeah, just give me a yeah. Yeah, and on the tax side, very crucial, need to take care of the taxation aspects, that there is no tax leakage because of investments from different jurisdictions, or maybe a feeder structure situated elsewhere, need to comply with FDI regulations and so on and so forth, whatever are the regulations of the local country. Need to make sure that it's a tax efficient structure and does not lead to unnecessary leakage of tax. In when investments are made in different jurisdictions, also need to take care of the withholding tax requirements of local tax filings and so on. Yeah, I mean, these are technical aspects which are well covered by professional tax advisors and lawyers, but yeah, something that we need to always take into consideration. Yeah, I mean, these are the key aspects which I thought can be covered in this period of time. And again, I mean, due diligence is not a very exciting subject with a lot of graphs and charts, but I tried to kind of make it more interesting by adding some examples from our past experience. And just to sum it up before I open it up for questions, is that the due diligence is, yeah, I mean, not so much a numbers game. Of course, there are numbers and you need to do the analysis and so on and so forth, but it's equally an art, so to say, to be able to judge whether the particular strategy and whether the management team or the fund manager that you are backing is going to deliver outperformance in future. I mean, looking at past numbers, it's okay, but yeah, I mean, you should be convinced and you should be able to make that analysis and that judgment, which has a lot of softer aspects than the quantitative aspects, to be able to make up your mind whether this is the right strategy and the team which will deliver outperformance in future. And that's the crucial part of the diligence. Yeah, maybe I'll stop there. I mean, we are also broadly running out of time, so we open it up for questions from the audience, if that's fine.
Thanks, Abhishek. Audience, we've got exactly 10 minutes before we move into the next session now, because we have back-to-back sessions for the next couple of hours. So if you have any questions, please quickly use the, uh, you know, ask a question tab and put in your questions for Abhishek. I'll be happy to take them on your behalf. Okay. So, Abhishek, here's the first question. What are
Okay.
the leading tools, data sources which you use for such assessments and due diligence, especially for funds in the Indian context?
Yeah, that's a great question. uh, so yeah, I mean, in terms of data tools, the standard databases which are available in the market, like Preqin, PitchBook, and so on, which are essentially data aggregators which are collecting data from a variety of sources, right from public sources to the filings, and so on and so forth. Those are the ones that we use for our preliminary screening. We wouldn't rely 100% on that, but yeah, that's something that we use for a preliminary screening, just to shortlist or figure out the top performing managers, so to say. And then we have our another analytical tool which helps us in slicing and dicing the data, comparing it with other fund managers across the world, across strategies, comparing it with the PME indices, and so on and so forth. So that's more like an analytical tool. It's not a database. It's a tool where we input the data of past performance received from the fund manager, which we are evaluating. So all that data goes in as an input, and then the analytical tool helps us in doing the analysis which we want to perform, usually on the funds that we are evaluating. So that's more like an analytical DD tool that we use. I hope that answers the question. Yeah. Yeah, okay. I think, Aditya, it seems that the session was either too boring or too clear, that there are no more questions. I mean, I'm happy to end or maybe wait a minute or so.
No, Abhishek, just hold on, because
Okay.
The questions might just come in. So we have a few minutes more, so just give me.
Oh, sure. Okay.
So guys, if you have any questions for Abhishek, please quickly put in. So till we get another question, Abhishek, would you like to share any anecdote or experience where you like a kind of a mistake where you made in similar due diligence that we were discussing, somewhere where you kind of really found it difficult or failed to
that's a good idea. I mean, I would maybe take one negative example and one maybe a positive surprise kind of an example. Let me start with the negative one. So this was 2018, economy doing quite well, things in US and Europe also going quite well, and we were evaluating a fund manager in Europe, which was going to be investing in industrial and machinery related segment. So that's a very capital intensive segment, and at that point in time that segment was doing quite well, and we estimated that this will continue to do well. And one issue that we had, or one DD aspect which we kind of spotted but we were not very negative about it, was that they were having a very concentrated portfolio. So the previous funds, fund 1 had, I think, 4 investments, and then fund 2 had 5 investments, and they said that they would reduce the concentration and increase the size of the number of investments in the new fund, which we thought was fine. I mean, because essentially they were building platforms and were planning to do a lot of add-ons and so on. So we were weighing whether it's okay to take that concentration risk and also to take that sector risk, saying that these are going to be investing only in industrials or machinery, automation focused companies. Probably at that point we thought, yeah, that was a good decision, and that segment will do well because of automation and so on and so forth, capital being easily available. But yeah, that's not turned out very well in the past 2 or 3 years, and that's been really badly hit by COVID, because yeah, people are not setting up new factories, challenges on travel and so on and so forth has really added to the woes. So that's one thing we kind of learned, that yeah, diversification across a couple of assets is really important. And yeah, maybe one positive example is, I don't know, I get back to this fund again, which I said was looking at hiring the CEOs first. And so this was one aspect which we liked, but there were a couple of other aspects which we did not like. So one was they had a very thin investment team. So they had 5 partners, 2 vice presidents, and 2 or 3 analysts. that's about it in the investment team. And we are like, this is a $1 billion fund going to do mid segment buyouts. They are going to be heavily involved. Of course, they had the CEOs and they had other teams, operating professionals team, and so on and so forth. But we were really concerned about the thinness of the investment team. But yeah, I think, I mean, the other aspects of the fund were so compelling that we went ahead with the investment, and that fund is doing quite well. And yeah, I think so some of these aspects turn out to be well, and sometimes some of these aspects don't fall in your favor. But yeah, that's how we learn from our experiences, and we take that ahead in this complicated DD scenario.
So Abhishek, next question is for new companies, all the elaborate financials may not be available in public domain. So how do you evaluate them?
Yeah, I think, I mean, for us, it's more how we look at the fund managers. But again, I mean, if you are looking, I mean, going one step down from a fund manager's point of view, when they are evaluating new companies which does not have elaborate past financials, then again, they are looking at what is the potential of that company, what is their growth plan, or what is their growth strategy. Does the product or the service that they are offering to their customers make sense in this current environment? And does the fund manager believe that the promoter has the capability to scale that product or scale that service and that business in the next 5 years? And based on those assumptions and their understanding of the market and business, it's an investment call. You're right. I mean, if it's a fairly new company or a startup for that matter, it's very difficult. There's not much of past financials, and whatever is there is not really relevant. I mean, the scale is so small that you need to have the vision to see the company's growth 5 years down. And if you believe in that, then the investment is merited in a company like that.
So the next question, and I'll have to keep it the last one, guys, because of shortage of time. So Abhishek, how are PE firms adapting automation on the ground currently, like for your operations or assessment of portfolio companies, uh, probably monitoring portfolio companies. So how are you using automation, or how are you adapting to automation?
Yeah. That's a good question. I'll probably take it in two parts. So at our level, at the investor level, we are seeing a lot of automation in terms of the analytical tool that I mentioned. Essentially, what that tool does is that they are collecting cash flow data from a huge number of funds across the world. And of course, that's not available on a named basis. That's just the database or the input that goes into the system. And when we put in our data of the fund manager, which we are evaluating, then that analytical tool kind of easily helps us in the analytics, comparing it with listed equities, checking the standard deviation as compared with the market returns, how much of the returns in the past have been purely due to improvement in the market, how much of that has been due to improvement in revenue, and so on and so forth. So that's something that we use, and we are using other simple tools like the CRMs for tracking our deal flow and so on and so forth, which is not something revolutionary, but yeah, that's probably a need to have for everybody in days like these. And I think on the underlying fund managers, I think the fund managers are also using a lot of systems in-house in terms of sourcing their deals. So, I mean, just to take an example quickly, maybe in a minute I'll sum it up. We were discussing with a fund, early stage fund. So what they've built is they've built a sourcing engine, which is of course checking what deals are happening on Crunchbase and all these other websites which are mentioning about deals. But they also have an AI tool which is tracking which entrepreneur is tweeting what on his tweet handle. So depending on what they are tweeting, the AI tool kind of judges that maybe this guy is building his next venture, or he has a product in mind, and that's the time to go and approach that entrepreneur before any other VC fund approaches them. So we are seeing all sorts of things in the market. Of course, I mean, it needs to be seen how successful that tool is, but definitely AI and technology is going to play a massive role in all industries, including private equity and including investments going forward.
Great, Abhishek. So I will, guys, will have to wind up the session. Our next speaker, Rahul, is already here. Abhishek, on behalf of the entire AIWM and IAAF community, as well as the participants and those who want to watch the video, I thank you for your time and efforts. And I also thank Karan Bandari for your colleague who's been, helping us with this entire
Thanks.
presentation part. So look forward to keep engaging with you more on such sessions, Abhishek. Thank you so much.
Absolutely. Absolutely. My pleasure. Thanks, Aditya, and
Have a
thanks
good
the entire team and the audience. Have a good evening. Bye.
Thanks. So welcome, Rahul. We'll just take a couple of minutes break before we dive into your session on
Sure, please take your
certification of
time.
AIFs. So just quickly grab a cup of tea if you want, and we can get
Sure,
going.
sure, sure. No worries. No worries.